Hello, everyone, and welcome to BFW 2401, week 5, part 3. Now, this is a continuation of the story which we just mentioned in part 2. Part 2, we decided on the target capital. Now, we decided the target capital now, and we are growing where we can finance this growth while maintaining that what we call capital target. So usually we increase our capital from the net income coming from last year after we deduct the dividends. So that part which comes after we take off the dividends from the net income from last year called the retained earning. So that retained earning is actually whether it's going to go up or down depends on how much dividends we are going to pay. So are we going to cut the dividends if we are growing, or are we going to keep stable level of paying of dividends payout, whether we are growing or not growing? This is the story that we are trying to explore this time. So if you allow me to share, and I think I can also go fast over this, this part. So we are talking about the internal organic source of capital. This part we already finished. And you can see this is part 3. So this part we already finished in part 1 and part 2. This is what we are trying to finish here. And then this will be left for the 4th part, including the calculation. Now, coming here, we know the source of capital. Either it can be generated from the internally, which means the retained earning that is left after left from the income after we pay dividends, or we can get it externally, which means just issue a new capital. And what do you mean by issue new capital? Just sell more shares of the bank or the company to the market and increase your equities. So the question is, what is the projected level of internally generated capital from retained earning? How much I could get and keep from the retained earning? And if I already have set the capital target, now if I am going with this, because as I told you, if I want to grow means I'm going to get more loans, means I'm going to increase my assets. So if I'm going to get more loans or make more investments, which means increasing my assets, I have to have this capital proportional, which means the capital target, which means how much is it? Assuming it's 10%, I already decide this is the target capital that actually will maximize the shareholders' wealth and will buffer my expected losses. So, and this, if I keep this in mind, which is a very important issue, because I will set the capital target. If I have the same level of risk over the years, then I will keep the same target capital. I will not change it by issuing more assets so the capital will decrease. So in this case, if I'm depending on the internal capital, any increase in the capital, I can be associated with the same percentage of increase in the total assets. And by that way, I can keep myself under the target capital for long time. So for example, if I have a bank who has 100 billion of assets, and then the target capital, which you already have set previously, is 10 billion. So we are talking about 10%. Now, because of the profit and all these things, and I have profits, and then that profit was, part of it was distributed as dividends, part of it keeps as retained earning. If that retained earning, which you called it the increase in capital, is say 2 billion. So now I have a capital of 2 billion. I can go ahead now and increase my asset by the same percentage. So I increase the capital from 10 to 12. I will increase the asset from 100 billion to 120 billion. So if you divide 120 billion over the 12 billion now, you will keep having the 10%, which you have it previously. End of the day, you are keeping the 10% capital, which is the target capital all the time. This is a very passive way to do it. Just have whatever increase in capital happens during the year, you increase your assets. Now, this is a very passive way to approach it, but if I don't want only the 10% increase in the assets in this example, say maybe I want to explore new market and I want to go to 20%, what I should do? Now, this question, to answer it, is to go for external capital, which means make new issues. Or somebody would say, you know what? I may just play without issuing more capital and going to all this headache. I can just decrease my dividends. Can I do that? This, we will answer this question in a way, in a moment. Now, come back to the principles. So the internally generated capital will depend on the profitability, which is actually out of our control completely. And also the dividends policy. So how much income we have through the competition, you know, our profit can be impacted by the competition, by our market share, by all these things, we will get more profit. But then out of that profit, we can start saying, okay, we are not paying 10% or we are not paying at all because we want to increase our capital in a way that allows us to increase our assets. Can we do that? Can we play with the dividends component? I can play. I don't know whether I can control. I don't know whether I can control the profitability because the profitability depends on the market. In my share in the market, and the competition, and so many factors are playing on my profitability. But dividends policy is a board decision. So we come now to the importance of dividends policy because it's a very sensitive issue for us as a bank or as a company. So retained earnings are the main internal source of capital. We understand this. Dividends affects the availability of internal capital, which means more dividends basically means less retained earnings. So dividends also affect the cost of external capital. What does it mean? If I'm not going to pay dividends and actually my shareholders are not happy with that, they will actually ask maybe for more return, or we bring some people who are willing to wait only for a long time to receive dividends, or maybe depends on the capital gain, and that will increase and may ask for more return. So there is a relationship between not paying dividends and my cost of capital. So the key question is, if we know that dividends is actually affecting the cost of capital and also affecting the internal capital, as we can see now, so what determines actually how much bank pays? Should I go for 10%, 20%, 5%? What is the percentage that actually is the best? So to reach to that decision, we have 4 theories, and I want you to be aware of those 4 theories. It's very important. One of them is saying shareholder preferences. Now, this theory came early in the 60s, and it's followed by Modigliani and Miller. You can call it MM, we call it MMM finance. These people say, whether you pay dividends or you don't pay dividends, it's the same from the perspective of the shareholders or the market. And their argument is based on no transaction cost, which means if you are going to pay dividends, the shareholders will receive these dividends and they will be happy about it. If you don't give them the dividends, you will take the dividends and become retained earning and increase the capital. You will increase your assets, you will get more profit, the share price will increase because your bottom line will increase. So in this case, that part of the dividends can be reflected actually in the share price. So for people who are willing to receive dividends and they are not happy with the increase of the capital gain, they can sell their shares. People who actually prefer capital gain and not preferring dividends, they can buy more shares. So this is the argument, which is they can, it depends on the form where how you want your return and the preferences of your shareholders' preferences of the form of the return they wish to have. But this theory assumes no transaction cost. What do you mean by transaction cost? First, no taxes. And let me tell you something about the taxes. In this country, for example, in Malaysia, and I know in so many other countries, they don't charge you, they don't tax you you don't report any tax returns when there is a capital gain. Only when you receive dividends, they will tax you. In the United States and some other countries, they will tax you for both, for the capital gain and the dividends if you receive. And therefore, you can see there is a chart for all these dividends who paid. The highest dividends is paid in the US, the smallest, I think, in Japan. And if you look at Malaysia, 32%. So there is so many countries, you know, some people come to 70% and then go to almost 5%. So actually, it depends. In this country, for example, in Malaysia, just an example, and international students, they can also see it in their countries. We have mostly family firms. And those family firms, actually, the family will own the company. And they don't, actually, they are the owners. They don't pay themselves dividends. This is one thing. And if they are going to receive dividends, they will report it as tax. And it will be tax deductible. And therefore, the dividends is not as much as other countries, for example, like the US. The transaction cost is the tax or any personal money management reasons. So this is actually the transaction cost. So M&M, which is the first theory, assumes tax. There is no tax and there is no any other transaction cost. So actually the investors are indifferent between you give them capital gain or you give them dividends, no matter, because they can change, depends, as I told you, it depends on their preferences. In which form they want it, they can. The person who wants dividends, they can sell their shares. They want dividends, you don't give them dividends, they can sell their shares. Somebody wants capital gain and you give them dividends, they can buy more shares. Now let's come to the next theory, which is what we call the second theory called clientele theory. And this can be very clear. Those people are asking for more dividends, just like that. And this is actually mostly in the US and those countries who have more people who have, especially those people in pension, and then they go and invest in companies and they receive dividends. They need to receive dividends to survive, actually, for expenses like salaries. And this is why in the United States, dividends are paid quarterly. It's not annual basis. They receive it in quarterly basis and they keep spent from that dividends based on their investment. So if you just say, no, there is no dividends, and you know most of your shareholders are of this type, it's a disaster because they would sell all the shares. It's a matter of survival now because they cannot, survive. I mean, this is, we talk about the US, you can talk about other countries with different circumstances. If they have, similar settings. So we talk about clientele theory, it's more dividends and more frequent dividends. Let's go to this theory. Agency cost. Agency cost is just the opposite. Now, agency cost is claiming that you need more dividends. They call for more dividends. This theory called for more dividends because they say if you leave the money inside the company, it just you give the management more resources to abuse it. So you take as much as you can and let them, the management spoil whatever less money is there. And they think by that, they decrease the agency cost because one of the agency costs is the misuse of the resources. And therefore, managers may not act and be, as I told you, in the best interest of the shareholders. So the shareholders' preferences now in this case is to have more dividends, because that will lead to less fund available for manager to misuse. Maybe this is the most important word among all those words here, the misuse. Okay, now let's go to come to the signaling theory. And this is actually a most common theory. Now the signaling theory, as you said, as I told you before, dividends is actually thing that will please in general the shareholders. But if you are growing, now you have to do something about it, because you want more, you want to retain more dividends and just give zero or less dividends. But there is a risk here. And in this case, you want to signal power and you signal strength and stability of the bank or the company. So in this case, you have to express or show to the shareholders that you are paying dividends and in the same time you are growing. And you are combining these two contradictory issues and making magics, so being so able to pay dividends and so able to grow, which is actually contradiction. And this is, I think I have taken 2 or 3 reports from Malaysian banks, and I have uploaded for you in the tutorial. Look at it. Those 2 people, I think 2 of those banks, one of them, I think Public Bank, and the other one is Maybank. 2 of them are saying we are growing in the annual reports. We are growing and we are paying more dividends. Public Bank even saying they paid 2 times or 2 times dividends during the year. So that actually what you call signaling theory. Signaling theory means you signal your power in the market. So the issue like this, decrease in dividends signal bad performance. If you're paying, for example, if you're paying a dividend of 15% of the operating income, and next year, and you receive $1, for example, as a dividend, maybe next year the operating income increased and you received $1.5, but actually it is not 15% of the operating income. It's only 10%. That signal a bad performance. Don't do it. Now, what you do is you have to divide establish what we call stable dividends management, and show that because if you have stable dividend signaling management in control, if you have stable dividends, that will signal actually a management that is in control and will give a positive effect to the share price. The first one will give a negative effect if you start decreasing the pay ratio, the payout ratio, even if you are increasing what you are paying, but you are decreasing the percentage, that is actually a negative effect. Now, the bottom line is like this. The solution for all those issues to be stable is to set up what we call a dividends ratio. And this dividends ratio should be stable all the time and all of the years. Now, somebody will tell me, sir, is this something like dividends smoothing? So whether we are increasing the dividends or whether return earning increasing or decreasing, we're still paying the same level of money, same level of dividends, so the shareholders are happy? No. Dividend smoothing is something else. This is stapling the what we call the ratio. So the ratio is total dividends payment over the net operating income. So maybe you say this is 50%. You are paying 50% of your operating income. So your operating income increases or decreases, you keep with the 50%. You make 100 billion, you make 50 billion profit, then in this case, you pay 25 billion. Or maybe 25 billion, which is the 50%. Next year, maybe there is losses, whatever, you go to, you're still making profit, but maybe the profit dropped to 30, you still pay 50%, but now it will become 15 billion. So we are talking about a percentage. We are not talking about a dollar value. Please understand this issue. So the effect dividends will rise if operating profits rise, and vice versa. If the operating profit goes down, the dividends will decrease based on the in dollar value, but the percentage stay the same. Now, I think this is the end of it. I just want to share with you other reports from the Australian Bank. They take this issue very seriously. Now, Westpac, for example, and NAB, which is National Australian Bank. Now, these people are saying this is actually the management, and they're telling this announcement, and they're telling the shareholders that they want to retain the capital because that will generate more profit and make more strength, and this is why they decided to decrease, to stop paying dividends. But they have to talk to the shareholders and tell them what is the reason. This is actually announcements. They understand that some shareholders are interested in dividends, but they say they take that to consideration. National Australian Bank also announced its announcement after NZ, which is Australian New Zealand Bank. We have 4 big banks: NAB, Westpac, NZ. So, and this also we're talking about. We intend to reduce our dividends to bolster our capital position as environment weakens. So these people are also calling for less dividends, but they need also to talk to their to their shareholders. With this, I conclude. So the take-home issue from this part is the internal capital that affected by profitability and dividends. But dividends is not an easy issue to decrease it or increase it. It has to be, it is a very sensitive issue, and it's governed by a few theories. Thank you very much. I stop this share, I stop this part, and I will see you in the next part. Thank you.